Hello and welcome to Triathlon Partners TV. This is Ira Coiner. Thank you very much for tuning in. And today we will be discussing the structured notes of December. I know everybody is really excited about this. It's always my favorite episode. We always get a lot of response and feedback on them. So we're going to go into a little bit why I like structured notes. If you've been watching this often, you know I'm a big proponent of them. Structured notes, simply, they're for long-term investors. 3 to 5 year horizon in a product that can offer protection if the market goes down and has the possibility, or the ones that I'll be speaking about, have increased returns if the market appreciates, meaning if the underlying index or asset that the structured note is about goes up 10%, we're going to have what we call a multiplier or participation ratio. And that could be, today, the ones I'm going to talk about are over 2. So if the market would be up 10%, this would be up 20%, right? So we'll get into the nitty gritty of the specifics. I have 2 today, which is fantastic. That's like regular episode plus a bonus, right? So first one is for those that are underweight or haven't been involved in international equities, right? Everyone's been focusing on the U.S. Stock market's done tremendous. Everyone's probably really happy looking at their balances, right? So thing is, you want eventually to have a diversified portfolio, right? And even though international stocks have been performing as well as U.S. stocks, it doesn't mean it's going to stay the same. And you don't know when it's going to change. So we're not playing a timing game here. What I'm doing is I'm bringing a product to you, which, hey, this has favorable terms, not timing, terms, right? So because everyone can get favorable terms, you just have to know, and your advisor has to bring them to you. So this one is called a worst of note. It's based on the performance of 2 separate indexes, right? One index is called the EFA, which is global international stocks, large companies based in the developed world, Europe, Australia, and the Far East. There you go. The second one is the SX5E, which is the index of the top 50 stocks in Europe, sort of like the Dow Jones, right? So you got, one is all Europe, one is developed world apart from the US and Canada. That's a good way to think of it. So at the end of the note, you will be compensated based on the performance of the worst performing one. Doesn't sound too great so far, worst, right? But the best way to phrase it. And it has some advantages, and I'll go into after the terms of the note. Now, the protection on this note, the barrier is 35%, meaning that if at the end of 5 years, the worst performing stock has lost 35% or less of its value, you will get 100% of your initial investment back. Has that protection? That's great. A lot of your no individual ETFs or stocks offer that. So if you're already long the market, you're worried about it, being too high, this is something to keep in mind because this is very beneficial, right? If it's down more than the 35%, you have a 1-to-1 loss, as if you are long the index, like you already are, right? So you have that promise of protection in that down 0 to down 35% window. You're made back home. If the worst performing index is positive, the note will pay off 2.47 times the return of that worst performer. So if that worst performer is up 10%, you will get 24.7%. If it's up 100% after 5 years, you will get 247% return on it. It's fantastic, right? You also get, of course, you always get your principal back when the market is up on the positive side too. So this is great. Now, the reason why you can't really shun this word worst performer is that by you agreeing to have the one, you don't know which one, the worst performing one, the issuer of the note is able to do things in the risk management to enhance this participation ratio. Because we can look at it, if yourself was going to be long 50% of one index and 50% of the other, you're going to be long the worst performing one and the best performing one. You don't know where they're going to align after the 5 years, but because you have one that you're not going to be long, they're able to do things to backtrack and to give an extra premium for that one that's going to be the worst performer, which is why they're able to put, which is the multiplier, which you're able to put that multiplier in there. They use derivatives and options, but that's the issuer's problem. That's not your problem, because once you get into this note, you're locked into the worst performer at that 2.47 multiplier, as well as that protection side on the downside of the 35%. Okay, that's great. So again, it's great, and it also fits right into your international exposure, which is great because I know a lot of you need it. Now, the second one that I want to talk about today is an offshoot of the S&P 500. Just so happens this is what the note's written on. It's called the S&P 500 Futures Excess Return Index, or the rolling futures contract. It doesn't include a dividend. So it's also a 5-year note. So you take where the note begins when you start and buy the note at the end of December, and 5 years time, and the difference between the starting and ending price is the return of the index. But that's not the return of your performance, because this note has a 2.3 times participation ratio. So if that index is up, if it's positive after 5 years, you take that return, you multiply it by 2.3. That's fantastic, and you get your initial principal back as well, of course. So the way that this is, what the SPXFP, which is the symbol of the S&P 500 Futures Excess Return Index, what it is it's supposed to denote what the S&P's return is beyond the risk-free rate, beyond the lending rate, beyond what it would get taking away the dividends as well. So it's has a 95% correlation with the S&P 500. So it is a very strong proxy for the index, but it's never going to perform exactly like the S&P 500. There have been some years that this past year, I think it's underperformed maybe by 8%, but there's some years that it overperforms by 1% or 2%. But why we like this product here is because of the multiplier, because we believe that that multiplier of 2.3 will make up for any difference in the lag of performance of the S&P 500 futures excess return versus the S&P 500. So it covers the same 500 companies. It's just there's a little bit of a discount rate on it, but it's 2.3 times the performance, which if you look up on historics, you'll see that this is a slam dunk no-brainer, as well as the protection is 30%. So if it's down less than 30% after 5 years, you get 100% of your money, right? So this is really all great. And so people are going to be like, well, how should I invest in this? Well, number one, give us a call, check us out on our website. It's great, and we'll steer you how to do it, right? Because we know the products. We look at hundreds of these notes every month, and we come up and show you the best ones we think are appropriate. Now, you might think these notes aren't for you, right? Because you don't have big bank account, big brokerage account. Well, you got to know, number one, minimum investment is $1,000. So if you're actively looking in the stock market and you're investing for your future, this most likely has a place in your portfolio. But let's keep in mind, this is for a long-term investment. This is not something to buy today, sell tomorrow. You should be keeping it the full length of the term, right? These things offer protection. That's the last thing you want to sell out of your portfolio is protection. 3, if you have money in an IRA, a Roth, a rollover, right? Anything that you have access to, that's a tax-advantaged account, so that if you sell a security, you don't pay taxes now. This is the account to put into right now, because I know a lot of you might have retirement accounts, like I've just mentioned, and you might have cash brokerage accounts. But if you take profit and sell from your cash brokerage account now, which is fine, you're going to incur some taxes, right? So, like, that's not a bad thing, because, all right, well, you're taking some profit, moving it around. But you got to realize you're buying things with the same exposure. Let's try and not get that tax bill coming now, because, replacing A for B, and if they're very similar, isn't the greatest thing. But again, if you have new money coming in, some Hanukkah gelt, some Christmas gifts, some Christmas bonus, inheritance, new money doesn't make a difference. But we certainly want to be very, very smart about taxes, and we don't want to pay extra taxes or unnecessary taxes. So again, rollover advantage retirement accounts, tax advantaged accounts, new money accounts, those are the places where these things are fantastic. All right, or to replace fixed income instruments, which typically don't have any gains because you're typically earning interest on them and they pay interest at your income tax bracket, which is usually high. All right, well, thank you very much for tuning in. This, once again, is Ira Coiner. Have a lovely and blessed day. Right now, I'm going to share with you the disclaimers, and please, check us out on our website and on our phone number. Yep. Take care. And here's the disclaimer.